A lot of investors buy bond funds because they think they're the safe part of their portfolio. But you can absolutely lose money in a bond fund. And that's why we prefer individual bonds as opposed to bond funds. Today I'm going to show you the difference between owning an individual bond or a bond fund, and why, for the way we use fixed income in our portfolio, we favor individual bonds and, for the most part, US Treasury bonds. Let's start with the Treasury bond. When you buy a bond, essentially what you're doing is loaning money to the US government for a stated period of time, and they're paying you an interest rate. You're getting interest payments, and there's a maturity. So at the maturity date, you're getting your principal back. Let's just say you're buying a 1-year bond, you're gonna lock your money up for 12 months, the government is going to pay you 4%, so you have, let's say, $100,000 into a bond, you're getting a 4% interest rate. Treasuries tend to pay semi-annual, so you'll receive two $2,000 payments throughout the year, and we know exactly what the maturity date is. So sure, while you're holding on to the bond, if it's a year, the principal amount can fluctuate up or down. But if you hold it to maturity, you're made whole. And you put $100,000 back in, you know what your interest rate is, what your payments are, and you're going to get back your principal at the maturity date. That is the advantage of using an individual bond. Again, it could be a muni bond or a corporate bond. We're keeping it simple with US Treasuries. I think they're giving pretty good interest rates right now as well. Treasury bonds, why I like them? They're predictable. I know how long I'm gonna hold it for. I know how much interest I'm going to get on it. And again, it might fluctuate while I'm holding it, but I know exactly how much I'm going to get back at a certain point in the future. A bond fund, on the flip side, is like any mutual fund or ETF. What a bond fund owns is a basket of different bonds, different issuers, or you could buy one that's all US Treasuries, but it's different bonds inside the portfolio that can have different yields, that can have different maturity dates, and a bond fund will trades on the market like an ETF, will fluctuate up and down as interest rates move up or down. So let's say you put $100,000 into a bond fund and it has a 4%, not stated interest rate, but a 4% yield. That means for the year, it's gonna kick off dividends of about $4,000. That can change. And keep in mind, if interest rates go up, the price of that bond fund can go down or will go down. There's no maturity date. So you don't know, there's not a stated point in time where, hey, I need to have some money that's safe and on the sidelines, I'm gonna put it into this bond fund, and in a year or 2 years from now, I'm gonna sell my bond fund for exactly what I put in. If the market goes down, everything gets hit. Why? Because people have to sell everything across the board. So when you have a big decline like we had in 2020 or 2022, the market was down 30%. If you were invested in bonds, those bond funds likely went down as well, because people are just hitting the exits, raising cash, and fleeing to the sidelines. Bond funds to me are more risky because they do go up or down. And if you want to own bonds for, let's say, a year, you don't know that if I pay this price for it, I'm getting back this price in the future. You know that you're owning a basket of bonds, it could be down here, it could be higher, but safe portfolio, I want safe, and I want to know exactly what I'm getting, which is why we favor a Treasury bond over a bond fund. That's a basket of bonds. Another thing to think about, let's say you needed money in 3 years. You just got married, you're looking to buy a house, or maybe you're getting close to retirement, you want to buy a vacation house, and you need money in 3 years. You have enough money invested in the market, and you don't want it to fluctuate. If I go and buy a 3-year bond, and I'm getting what my interest is, I know what the interest that I'm getting for holding on to that bond is, but most importantly, I know if the maturity is 3 years, I'm gonna be made whole from the US government in 3 years. On the flip side, if I put it into a bond fund and say I'll sell this bond fund in 3 years, there's no guarantee that you're going to get your exact principal back that you put into it. So that's our approach. When we wanna have a safe portion of the portfolio, we ignore bond funds, we buy individual bonds. For the most part, we're buying US Treasury bonds, and we think that's the way to play it.